A company that designs the chip inside almost every Android phone on the planet? A company whose patents are so foundational that every single device connecting to a wireless network owes it money. And the stock is down more than 40% from its highs, trading at a valuation that says this business is in serious trouble. It scored 7.3 out of 10. The verdict is buy. Let's break it down. Qualcomm runs two businesses. The first one designs and sells processors, modems, and wireless chips, the actual silicon that goes into smartphones, cars, PCs, and connected devices. That side did $38.4 billion in revenue last year. The second business is a licensing machine. Qualcomm holds roughly 140,000 patents, covering the technology required for 3G, 4G, and 5G connectivity. Every company that makes a device connecting to a wireless network pays Qualcomm a royalty. That licensing arm brought in $5.6 billion at 72% pre-tax margins, meaning for every dollar it collects, 72 cents is profit. And here's the key. That royalty revenue comes in regardless of whose chip is in the phone. Even if a competitor builds a better modem, they still owe Qualcomm for using the wireless standards it helped invent. So why is the stock this cheap? One word: Apple. Apple has been Qualcomm's largest customer, historically accounting for 20 to 25% of total revenue. And Apple has spent 6 years and over $1 billion building its own modem chip to replace Qualcomm's. It launched the first version in early 2025, shipped an upgraded version in 2026, and by 2027, Qualcomm expects to supply 0 iPhones. That is $7 to $8 billion in annual revenue walking out the door on a defined timeline. The market looked at that and decided Qualcomm is a shrinking business. The stock price reflects it. But here's where it gets interesting. The market is pricing in the loss. What it's not pricing in is the replacement. Qualcomm's non-smartphone businesses, primarily automotive, Internet of Things, and AI-powered PCs, grew 27% last year to $10.6 billion. That's real revenue today, not a slide in a pitch deck. Automotive alone crossed $1 billion per quarter in late 2025 and is guided to grow above 35% this quarter. The company has a $45 billion design win pipeline in automotive. What that means is contracts where automakers have already committed to using Qualcomm's chips in future vehicles. That pipeline stretches over a 7-year production window and backs management's target of $8 billion in annual automotive revenue by fiscal 2029. So the question every investor needs to answer is, can these new businesses replace the Apple revenue before the gap becomes structural? That's the entire thesis in one sentence. Let's look at what the money is actually doing, because this is where Qualcomm starts to look very different from what the stock price suggests. The company generated $12.8 billion in free cash flow last year. That's real cash in the door after paying every bill at a 29% margin. To put that in context, 29 cents of every revenue dollar turns into cash the company can do whatever it wants with. Capital spending runs at just 2.7% of revenue because Qualcomm doesn't own its own factories. It designs chips and outsources manufacturing. That's what makes it asset light and why the cash flow is so strong relative to revenue. Cash return on invested capital has climbed from 38% to 50% in 3 years. For every dollar invested in the business, it gets back 50 cents in cash every year. To give you a benchmark, 20% is considered exceptional in this framework. Qualcomm is at 2.5 times that. I mean, look at that number. That's a business converting capital into cash at an elite rate. And the stock is priced like it's broken. And what are they doing with all that cash? They returned $12.6 billion to shareholders last year. $8.8 billion went to buybacks, buying back its own stock, which reduces the share count and makes each remaining share worth more. $3.8 billion went to dividends. The share count has declined from roughly 1.12 billion to 1.07 billion over 3 years, about a 4% drop. What that means is your slice of the company gets bigger, even if you don't buy another share. And critically, all of this was funded entirely from the cash the business generates. No debt taken on, no outside capital needed. Unlike companies that have to borrow money to fund a transition, Qualcomm is paying for its diversification, its R&D, and its shareholder returns, all from the same cash engine. Now let's talk about the balance sheet, because this tells you whether the company can survive the transition even if things get bumpy. Debt to EBITDA is 1.06 times, meaning Qualcomm could pay off all its debt with about 1 year of earnings. Interest coverage is 18.6 times. It earns 18 times more than it needs to cover its interest payments. Credit ratings sit at A and A2 with stable outlooks, near the top of the scale. The $14.8 billion in debt is entirely fixed rate, so the interest cost never changes, and it's staggered from 2027 through 2053, so nothing big comes due all at once. With $10.2 billion in cash, a $4 billion undrawn credit facility, and a $4.5 billion commercial paper program, a short-term borrowing facility, Qualcomm has over $18 billion in accessible liquidity against $14.8 billion in total debt. Whatever happens to growth, this company is not going bankrupt. So the revenue is under pressure from Apple leaving, but the cash flow is elite, the balance sheet is a fortress, and the replacement revenue is growing at 27%. Now let's look at what the market is actually paying for all of this. Qualcomm trades at 9.9 times EV over EBITDA. That's the price tag on the whole business relative to what it earns, and lower is cheaper. For context, that's 23% below Qualcomm's own 10-year median. It's less than half what most semiconductor peers trade at. Broadcom trades at nearly 40 times. AMD trades at 48 times. Even NXP, the closest comparable, trades at 15 times. Free cash flow yield is 8.8%. What that means is the business generates $8.80 in cash for every $100 you invest in the stock. That's double the 10-year Treasury yield at 4.4%. Forward price to earnings is about 12.5 times, less than half the semiconductor peer average of 20 to 25 times. That's honestly hard to believe. A company generating nearly $13 billion in free cash flow, growing its automotive business above 35%, sitting on $18 billion in liquidity, and the market is pricing it cheaper than almost every chip company out there? A sum of the parts analysis, valuing each business separately and adding them up, puts the base case share price around $150. The bull case, where automotive hits $8 billion by 2029 and the stock gets repriced higher to 16 to 17 times earnings, puts the target at $185 to $195, roughly 42 to 49% above today's price. The bear case, where Apple accelerates, China revenue contracts 15 to 20%, and earnings drop to $7 to $8 per share, puts the floor around $95 to $110, about 16 to 27% downside. The asymmetry ratio is roughly 2 to 1. The upside is about double the downside. At current prices, the market is pricing in zero success from diversification. If even one growth engine scales, the stock is mispriced. But this isn't a free lunch. Let's talk about what could go wrong, because the risk profile here is medium-high, and there's a reason for that. The Apple exit is structural and irreversible. Apple spent $1 billion and 6 years building its own modem. It's not coming back. That's $7 to $8 billion in revenue disappearing on a known schedule. More than 60% of Qualcomm's revenue comes from China. US-China tensions have intensified consistently since 2018, and any expansion of export controls to cover Qualcomm's mobile or automotive chip categories would directly hit the company's largest revenue geography. That's not a theoretical risk, it's an ongoing policy discussion. On the competitive side, MediaTek leads globally by unit share and is pushing into premium tiers. Samsung and Huawei are both pursuing in-house chip alternatives, following Apple's playbook. The trend of your biggest customers building their own replacements is a structural headwind. And there are management concerns. CEO Cristiano Amon's direct ownership is minimal, roughly 0.014 to 0.020% of shares outstanding. He sold 150,000 shares in October 2025 at about $165, cutting his direct holdings in half. Last year's $8.8 billion in buybacks were executed at an estimated average of $157, now roughly 17% underwater, with the stock at $131. The execution track record is strong. Cash ROIC at 50%, clean acquisitions, conservative guidance that management consistently beats. But the alignment picture at the top has a gap. Here's the one thing that decides whether the bull case or the bear case wins. The thesis-breaking risk is a compound scenario. Diversification stalls below 20% growth, while China revenue simultaneously contracts from export controls. Neither alone would be fatal. Both together turn the revenue trajectory negative and leave a cost structure built for a larger business. The current price already assumes this is the base case. The analysis says it is not. So what should you watch? Automotive revenue growth? It needs to stay above 20%. Non-handset revenue as a share of the chip business? It needs to approach 40% by fiscal 2028 from 28% today. QTL licensing revenue? It needs to hold above $5 billion annually. Apple's modem transition pace? Any acceleration worsens the revenue trough timing. And US export control developments, specifically whether restrictions expand beyond AI-specific chips. The catalyst path runs through automotive and the DRAM memory shortage resolution expected in the second half of 2026. Automotive growth above 35% this quarter is the next confirmation point. If the memory shortage resolves on schedule, it would release pent-up handset demand and push near-term earnings above depressed consensus estimates. The trade report will be monitoring all of these items and will post across all social media channels as soon as any of them hit or miss their thresholds. Follow so you don't miss those updates. Qualcomm scored 7.3 out of 10. The analysis says buy, but this isn't a straight line up. There's likely a rough stretch as the Apple revenue rolls off before the new businesses fully replace it, so the stock could trade lower before the thesis plays out. The financial profile is exceptional. Cash flow, balance sheet, and valuation all scored 8. The competitive position is the weakest dimension at 6. At 9.9 times EV over EBITDA, the valuation is doing heavy lifting. The market has decided this is a smartphone modem company losing its biggest customer. What the market underweights is the scale and velocity of replacement revenue that's already showing up in the numbers. The asymmetry favors the long side roughly 2 to 1. The market is pricing the loss without pricing the replacement. That is what makes this interesting on a 2 to 3 year horizon. If this breakdown was useful, hit like and subscribe. This channel covers deep dives into individual stocks, breaking down the business, the financials, the risks, and whether the price makes sense. More coming soon. This is for educational and entertainment purposes only, not financial advice.